I think the North American Trust remains fairly defensively positioned, as has been the case for the better part of a year, perhaps a bit longer. But I think the backdrops are kind of different. So if you looked last year, we looked at valuations over 20 times. We saw fiscal policy at sort of peak, very aggressive levels. And we saw monetary policy with the Fed, not only keeping rates at zero, at the zero bound level, but also quantitative easing. Fast forward to currently, fiscal policy is much more modest, only slightly accretive to GDP this year. And monetary policy has gone from a 0% interest rate to a 5% interest rate. And quantitative easing has turned into quantitative tightening, such that money supply is actually flat to down currently. I think that backdrop, does bode for a more defensive outlook. And valuations, which is the third part of this, has derated a bit lower. But the market, when we look at the S&P, it's trading at roughly 19 times forward earnings. And the stocks in the North American Income Trust typically trade on average between 13 and 14 times at a portfolio level. So we remain a bit defensive. We like that cushion of safety with our valuations, which we think valuations will matter with higher discount rates. And I think, importantly, concentration in this fund is also important. We're not looking for 60, 70, 80 names. We're looking for really the 35 to 40 best companies that fit that combination of growth and income at fair valuations. The trust had a good year in 2022. We exceeded 10% on a total return basis. This compares to our benchmark, which is the Russell 1000 Value Index, that returned just over 4%. Conversely, the S&P, which is a little bit more tech-heavy and is outside of sort of our dividend remit, if you will, was down over 8.5%. Yeah, I think if we look back over the past few years, sort of since the pandemic, there was a lot of volatility in those first couple of years in 2020, 2021, where we were really able to actively rotate the portfolio to higher quality names that were sort of had sold off during the initial outset of the pandemic, and then really sort of fine-tune those companies that we thought would be better positioned going forward. I think over the past year, our changes have been much more methodical. If we have stocks that, have lagged for what we deemed sort of the wrong reasons, or just simply, underperformed, and we feel pretty good about those. We feel good about valuations. We've been topping those up. And conversely, names that have done well and maybe have had a bit of an outsized move where valuation is a bit more stretched than it was, we've been sort of top slicing those. So most of our moves have sort of been inside the portfolio, more so than adding and subtracting new names from the portfolio. Yeah, so two of our bigger holdings are a bit more the ones that you may not expect in sort of a dividend fund. One is Analog Devices, which is a analog semiconductor company. And what we like about that is they've just completed a couple acquisitions over the past 3-4 years. They're really sort of hitting their stride. And we like sort of the secular outlook for their business line, and importantly, the free cash flow provides, most of which is being returned to shareholders in the form of dividends and share repurchases. We feel pretty good that despite a little bit of a demand weakening backdrop over the past year, that's poised to turn, given that their end markets are sort of secular growers in demand of semiconductors, where supply is a bit freed up. So we like Analog Devices, and we think that at current valuations, it's fairly valued with a very good growth profile. Another name that we've looked at and we own in size is a company called MetLife. Not quite as interesting perhaps as Analog Devices, but it has sort of a best-in-class group benefits franchise. It's got great market share. It has very good pricing power. And it does this in a backdrop where it only trades at less than 9 times forward earnings. It gets lumped in with other life insurers, which is really not where it belongs. This is a very strong, consistent grower, and we feel very good about the outlook here. We feel very comfortable that the downside here is quite limited. So if the market was to weaken, we feel very good about MetLife holding at current levels. Yeah, I think the macro outlook is remains difficult. We spoke earlier about the Fed with monetary policy being restrictive, fiscal policy not lending a lot, and inflation continuing to be off peak levels, but still at very high levels. So it's something where the fundamentals aren't there. I think what's important, as manager of the North American Income Trust, is we really just have to focus on the 35, 40 best companies that we feel have the ability to grow earnings, in a tough backdrop where free cash flow won't be constrained and can be returned to shareholders. And we can continue to execute on our remit, which is to, grow the capital account, pay a progressive dividend, and keep reserves sort of above that 1 year threshold, which we've maintained for the last few years.